Friends, thank you for being here today. What if I told you that the most dangerous event of the last 50 years was not a missile launch, a terrorist attack, or a pandemic, but a silent financial transaction that happened quietly behind closed doors in Beijing? And why should a decision made by a central banker thousands of miles away determine the price of your morning coffee, the safety of your pension, or the future of the global economy? These are not hypothetical questions. They are the reality we're living in right now. We are standing on the precipice of a historical shift so vast that most people cannot even perceive it. Yet its tremors are already shaking the foundations of our daily lives. Today, I want to walk you through a story that you won't hear on the nightly news. It is the story of how the economic engine that has driven the world for half a century has broken down, and why the silent earthquake of China selling U.S. Treasury Bonds signals the end of an era. To truly grasp the magnitude of this shift, we must first examine the broken mechanism of the American economy, how the national credit card finally maxed out. To understand why this is happening, we first need to strip away the jargon of Wall Street and look at the global economy in simple human terms. Imagine you have a neighbor. Let's call him Sam. Sam lives in the biggest mansion on the block. He drives 3 luxury cars, takes vacations 5 times a year to the most exotic destinations, eats at the finest restaurants, and wears the most expensive clothes. From the outside, Sam looks incredibly successful. But one day, you discover a secret about Sam. You find out that he doesn't actually earn enough money to pay for any of this. Instead, Sam is paying for his lavish lifestyle entirely with a credit card. But this isn't just any credit card. It is a magical card where Sam himself gets to decide what his credit limit is. And when the bill comes at the end of the month, Sam simply prints more money to pay it. This, my friends, is exactly how the United States has operated for the last 50 years. It is a country that consumes far more than it produces, imports far more than it exports, and spends far more than it collects in taxes. The difference, the massive gap between what they earn and what they spend, is covered by issuing debt. These are the famous U.S. Treasury Bonds. For decades, the system worked like a perfect, albeit dangerous circle. The United States would print dollars to buy goods, televisions, computers, furniture from countries like China. China would receive those dollars, and instead of hiding them under a mattress, they would loan them back to the United States by buying Treasury Bonds. It was a symbiotic relationship. The U.S. got cheap loans to fund its deficit and maintain a high standard of living. China got a massive market for its exports and a safe place to store its savings. It seemed like a win-win. But there was a fundamental flaw in this arrangement, a flaw that everyone ignored until it was too late. The system was built on trust. It relied on the world trusting that the United States would always be a responsible steward of the global currency. It relied on the belief that the dollar was a neutral tool of trade, not a weapon of war. But that trust has been shattered. China, the biggest foreign banker to the United States for decades, realized it was funding its own containment. They looked at the geopolitical chessboard and saw a troubling reality. Why lend money to a country that surrounds you with military bases? Why hold your life savings in the currency of a nation that threatens you with tariffs and sanctions? The wake-up call was absolute. When the United States and its allies froze the assets of Russia following the invasion of Ukraine, a shockwave went through Beijing. If Washington could seize the reserves of a nuclear power like Russia with the stroke of a pen, what would stop them from doing the same to China? China realized that its safe investment was actually a trap. And so they did what any prudent investor would do when they realized their bank is risky. They started to withdraw their money. This brings us to the event that changed everything. China didn't panic. They didn't dump all their bonds on a Tuesday afternoon, which would have crashed the global economy and destroyed the value of their own remaining assets. Instead, they acted with the patience and strategic foresight that has defined their civilization for millennia. They sold gradually, methodically, month after month, year after year. The numbers are public for anyone to see in the U.S. Treasury data, though few bother to look. At its peak, China held over $1.3 trillion in U.S. debt. Today, that number has fallen to under $800 billion. They have offloaded more than $500 billion. That is $500 billion that is no longer financing the American deficit. $500 billion that the U.S. government now has to find elsewhere. This is the silent earthquake. It wasn't a threat shouted at the UN. It was a withdrawal of financial support that signals the end of American economic hegemony. I want to pause here for a moment because this is the crux of the matter. I'm curious to hear your thoughts on this strategy. Do you believe China's decision to sell this debt was an inevitable act of self-defense, or do you see it differently? Please take a moment to share your perspective in the comments below. I read as many as I can. Now that we see why the debt is being sold, we have to ask, what are the alternatives? And how is the world building a future without the dollar? If China is selling dollars, you might ask, where's that money going? Is it vanishing into thin air? No, it is moving into assets that Washington cannot control, freeze, or print. The most obvious destination is gold. Look at the actions of the world's central banks. For the last few years, they have been buying gold at a pace we haven't seen in decades. Why gold? Because gold has no counterparty risk. If you hold physical gold in your vault, no foreign government can sanction it. It is the ultimate insurance policy against the weaponization of the dollar. But it's not just gold. We are witnessing the construction of a parallel financial system. For 50 years, if you wanted to send money from Toronto to Tokyo or from Beijing to Berlin, you had to use a system called SWIFT. SWIFT is technically a messaging system for banks, but it is effectively controlled by the Western powers. It is the plumbing of the global economy, and as we saw with Iran and Russia, if the US wants to punish you, they cut you off from the plumbing. China, seeing this vulnerability, has spent years building an alternative. It is called CIPS, Cross-Border Interbank Payment System. It is a way for countries to trade with each other without their money ever touching an American computer server. They are also rolling out the digital yuan, a currency that allows for instantaneous, direct settlements between nations. We are seeing bilateral trade agreements exploding across the global south. The BRICS nations, Brazil, Russia, India, China, South Africa, and their new members, they are trading in their own currencies. India buys Russian oil in rupees or dirhams. Brazil trades with China in riel and yuan. Saudi Arabia, the very architect of the petrodollar system in the 1970s, is now openly discussing selling oil in currencies other than the dollar. To understand how significantly the world has changed, look at the failure of the sanctions on Russia. When the conflict in Ukraine began, the United States and Europe unleashed what they called the mother of all sanctions. The explicit goal was to crush the Russian economy, cause the ruble to collapse, and force a surrender through financial strangulation. The assumption was based on a 1990s worldview, that the US economy was the only game in town, and being cut off from it meant death. But what happened? The Russian economy did not collapse. In fact, it grew. Why? Because the world had changed. Russia simply turned east and south. They sold their oil, gas, and fertilizer to China, to India, to the rest of the world that was hungry for resources and indifferent to Western geopolitical goals. The sanctions failed because the United States assumed it still had a monopoly on global commerce. It didn't realize that a safety net had been built. The global south looked at the sanctions and didn't see justice. They saw risk. They saw a bully weaponizing the banking system, and they accelerated their move toward alternatives. This is the new reality. The US can no longer command the global economy. It can only isolate itself from it. As the empire loses its financial grip, we are witnessing a severe blowback in the form of tariffs, soaring inflation, and the rise of what many are calling a rogue state. So, how does a declining empire react when it realizes it is losing control? Does it adapt? Does it humble itself and negotiate a new, shared power structure? Unfortunately, history tells us that empires rarely go quietly. They lash out. The reaction from the United States has been one of desperation. Unable to compete purely on economic efficiency, Washington has turned to protectionism, and we are seeing a wave of tariffs that would have been unthinkable 20 years ago. For those of us in Canada, this is where the geopolitical becomes personal. When the US government slaps a 25% tariff on imports from its neighbors and allies, it is not an act of strength. It is an act of weakness. It is an admission that they cannot compete. But who pays for these tariffs? The politicians will tell you that China pays or Mexico pays. That is a lie. Tariffs are taxes on consumers. When the US puts a tariff on Mexican goods, the price of avocados in the grocery store in Chicago or Toronto skyrockets. The price of your morning coffee jumps because the beans, the sugar, and the transport all cost more. Consider the lumber industry here in Canada. The US has repeatedly attacked Canadian softwood lumber with tariffs, claiming unfair competition. The result? It becomes too expensive to build houses in the United States. They are hurting their own construction industry and their own home buyers in a desperate attempt to protect a few producers. Or look at energy. The American Midwest relies heavily on electricity imported from Canada. If they pursue this path of isolationism and tariffs, they are destabilizing their own power grid. They are shooting themselves in the foot and hoping the bullet hits us. This behavior has consequences. The United States is increasingly being viewed, even by its traditional allies in Europe and Canada, as a rogue state. It is becoming unpredictable, hostile, and unreliable. We see this in the tourism sector. How many of you, or people you know, have changed your vacation plans? Perhaps you used to spend winters in Florida or Arizona, the snowbirds. But now, with the political rhetoric so hostile, with the instability so palpable, many Canadians are choosing to stay home or go elsewhere. They are taking their pension dollars to Europe, to the Caribbean, or keeping them in Canada. That is a direct blow to the US service economy, caused entirely by their own political atmosphere. The tragic irony is that by trying to make America great again through isolation, they are making America expensive, isolated, and lonely. However, this isn't just a foreign policy issue. We need to confront the domestic crisis, where political scapegoating is being used to mask a harsh systemic reality. While the international foundation of the U.S. empire crumbles, the domestic situation is equally volatile. But if you turn on the television in the U.S., you won't hear a deep analysis of bond markets or multipolar geopolitics. Instead, you hear scapegoating. The narrative being sold to the American worker is that their problems, their stagnant wages, their crumbling towns, their uncertain future, are caused by the poorest, most vulnerable people on the continent, undocumented immigrants. Let's look at this with cold logic. The United States is a wealthy economy of 330 million people. There are perhaps 10 to 12 million undocumented workers, mostly doing the backbreaking agricultural and service jobs that keep the economy running. To claim that these 10 million poor people are the cause of the systemic failure of the U.S. economy is mathematically ridiculous. It is a distraction. It is a classic magician S-trick. Look over here at the border, so you don't look at the boardroom. The real issue facing the American economy is not the people at the bottom. It is the structure at the top. We like to think we live in democracies, that we got rid of kings and queens centuries ago. But have we? In the American economic system, 3% of the population are employers. The other 97% are employees. In the workplace, where we spend the majority of our waking lives, there is no democracy. The king, now called the CEO, decides what to produce, how to produce it, where to produce it, and what to do with the profits. The system concentrates wealth and power in the hands of the few, leaving the vast majority to fight over the scraps. And when that majority gets angry, the elites don't offer structural change. They offer them a scapegoat. They point to the immigrant, the Chinese worker, the Canadian lumberjack, and say, he took your job. Compare this to the challenge posed by China. I'm not here to praise the Chinese political system, which has its own deep flaws and lack of political freedoms. But economically, they are doing something the US is not. They have a hybrid system. In China, the government steers the economy toward national goals. If they decide that the country needs a high-speed rail network to connect its cities and modernize its logistics, they build it. They don't ask, is it profitable next quarter for a private company? They ask, is it good for the nation in 10 years? The result? If you travel to China today, you will ride on trains that are faster, cleaner, and more efficient than anything in North America. Meanwhile, the US, which once led the world in infrastructure, cannot even maintain its bridges. The US capitalistic model, driven purely by short-term profit for that 3% of kings, has stripped the country of its industrial base. Corporations move factories to China not because Beijing forced them, but because they wanted higher profits. Now, facing the consequences of that deindustrialization, they blame China. It is a refusal to look in the mirror. This refusal to look in the mirror reveals a psychological trap that is perhaps more dangerous than the economic indicators themselves, the complete loss of our margin for error. You see, for the last 50 years, the United States operated with a massive cushion of safety. It was like a giant ocean liner on a calm sea. It was so wealthy, so dominant, and so powerful that it could afford to make terrible mistakes and still survive. Think about it. The U.S. could launch disastrous wars in Vietnam, Iraq, or Afghanistan, spending trillions of dollars with no clear victory, and yet the dollar remained the world reserve currency. It could deregulate its banks, cause the global financial meltdown of 2008, and simply print its way out of trouble. It could deindustrialize its own heartland, sending jobs overseas, and cover up the loss of wages with cheap credit and cheap imports. The unspoken rule was simple. If everything is going your way, you can afford to make mistakes. The momentum of the empire was so strong that it compensated for incompetence, bad strategy, and arrogance. But here is the hard truth that Washington refuses to accept. The wind has turned. The momentum is gone. The slack in the rope has run out. In this new, fragile environment, every mistake compounds the next one. There is no longer a cushion to absorb bad decisions. We saw this play out with brutal clarity in the failed sanctions against Russia. The U.S. leadership, operating on an outdated 1990s mental map, believed that sanctions would cripple Moscow in weeks. They gambled that the world would fall in line. They were wrong. Instead of a collapse, they triggered a realignment. They inadvertently strengthened the alliance between Russia and China, pushed India to seek discounted energy, and forced Europe into an economic crisis. A mistake of that magnitude in 1980 might have been absorbed. Today, it is fatal. It exposed the limits of American power for all to see. It showed the global South that the emperor has no clothes, and what happens when a leadership class is in denial about their loss of power. Do they pause and reflect? No, they double down. They engage in what we call a Hail Mary strategy, a desperate, long-shot pass at the end of a losing game. This is exactly what we are seeing with the new tariff wars. Having failed to contain rivals through sanctions, they are now trying to contain them through blunt taxation. But just like the sanctions, this was not thought through. They are swinging a hammer in a room full of glass. They don't know, and perhaps in their desperation don't care, that the shards of glass will hurt Canadian lumber mills, Mexican farmers, and American families just as much as Chinese factories. This psychological state, this deep-seated denial, is the most volatile factor in the world today. A declining power that believes it is still ascending is dangerous. It makes rash decisions. It alienates allies like Canada because it assumes we have nowhere else to go. It treats economic policy not as a science, but as a weapon of vengeance. We are no longer watching a strategic chess match. We are watching a gambler chasing his losses, raising the stakes with money he doesn't have, hoping that one last roll of the dice will bring back the glory days of the 20th century. But the casino has changed owners, and the old rules no longer apply. To understand why this gambling mindset has taken over, we must look deeper into the structural decay of the economy itself, a phenomenon we might call the hollow economy, where finance has devoured industry. To fully understand why this checkmate is approaching, we must look beyond the bank accounts and look at the physical reality of our nations. We have to ask a fundamental question. What is an economy actually for? Is it a casino designed to generate paper profits for a tiny elite? Or is it a machine designed to provide goods, services, and stability for the people who live in it? For the last 40 years, the United States has undergone a transformation that is often described as financialization. That is a polite way of saying that the country stopped making things and started making money from money. Walk through any former industrial town in the American Rust Belt, places that used to be the envy of the world. What do you see? You see the ghosts of a productive past. The steel mills are closed, the factories are empty or converted into luxury lofts for the few who can afford them. The jobs that offered a middle-class life with a pension have been replaced by gig economy work, delivering food or driving cars for an app. This didn't happen by accident. It happened because the kings of the American economy, those CEOs and shareholders we discussed earlier, made a calculation. It is cheaper to manufacture in Shenzhen or Vietnam. It is more profitable to use corporate cash to buy back their own stock and inflate the share price than it is to invest in new machinery or research and development. As a result, the U.S. economy became hollow. It looks massive on paper. The GDP numbers are huge. The stock market hits record highs. But it is a fragile giant. It is an economy built on consumption, debt, and services, not on production. We saw the danger of this during the pandemic. Suddenly, the wealthiest nation on earth could not produce enough face masks. It could not produce enough respirators. It was scrambling for basic computer chips to build cars. Why? Because the actual capacity to do these things had been outsourced in the name of efficiency and profit. Now, contrast this with the strategy of the competitor. While the US was financializing, China was doing the opposite. It was building the real economy. If you look at the skylines of major Chinese cities or travel between them, you see the difference immediately. China has built nearly 45,000 kilometers of high-speed rail in less than 2 decades. You can travel from Beijing to Shanghai, a distance similar to New York to Chicago, in just over 4 hours, on a train that is quiet, clean, and punctual. In the United States, that same journey takes nearly 20 hours on an Amtrak train that shares tracks with freight and is often delayed. Why this disparity? It isn't because American engineers forgot how to build trains. It is because the American system asks only one question. Is it profitable next quarter? Building infrastructure is expensive. It takes years. It doesn't pay off immediately. So, in a system obsessed with short-term stock prices, it doesn't get done. China asks a different question. Does this build national strength? They understand that a high-speed train might not make a profit on the ticket price alone, but it allows commerce to flow, it connects workers to jobs, and it creates a spine of steel and concrete that holds the nation together. This is the great divergence. One power has accumulated assets, ports, bridges, factories, gold, and commodities. The other power has accumulated financial instruments, derivatives, stocks, and bonds. And here is the brutal truth about the bond sale we started with. You cannot eat a stock portfolio. You cannot shelter under a derivative during a storm. You cannot fight a conflict with a hedge fund. When push comes to shove, when the geopolitical tension rises, real assets win over paper assets. China's selling of U.S. debt is essentially a trade of paper for reality. They are trading the promise of American wealth for the tangible reality of gold, energy, and infrastructure resources in the global south. Meanwhile, the United States is left holding its own paper, trying to convince the world and its own citizens that the stock market graph going up is the same thing as national health. It is not. It is an illusion. And as the silent earthquake rumbles on, that illusion is becoming harder and harder to maintain. All of these factors, the debt, the alternatives, the reaction, the denial, and this hollow economy, are converging into one inevitable consequence, a slow but certain checkmate. So where does this all lead? We have a U.S. government that continues to spend trillions of dollars it doesn't have. We have the biggest buyers of that debt, China, Japan, Saudi Arabia, stepping away. This leads us to a terrifying economic reality: monetization of debt. If foreigners won't buy U.S. bonds, who will? The answer is the Federal Reserve. The U.S. central bank has to step in as the buyer of last resort. They print new dollars to buy the government's debt. We saw this during the pandemic, and we saw the result: inflation. When you conjure trillions of dollars out of thin air, the value of every existing dollar in your pocket goes down. That is why your grocery bill is up 30%. That is why rent is unaffordable. Inflation is not an accident, it is the policy. It is the only way a bankrupt empire can keep the lights on, by devaluing the currency that you worked your whole life to save. As we look to the future, there are 4 possible scenarios. The first is negotiation. The US could accept that it is no longer the sole superpower. It could sit down with China, Europe, and the BRICS nations and design a new global financial system, a new Bretton Woods. This would be the rational, safe path. Unfortunately, given the hubris in Washington, this is highly unlikely. The second is resistance. The US fights to maintain its hegemony at all costs. This means more wars, more proxy conflicts, more weaponization of the dollar. This is a dangerous path that could lead to global catastrophe. The third is hard landing, a financial crisis that makes 2008 look like a picnic. If the bond market freezes, interest rates could spike uncontrollably, collapsing the housing market and the banking system. The fourth, and most likely scenario, is fragmentation. We are moving toward a multipolar world. The global economy will split into blocks. There will be a dollar bloc, the US, UK, maybe parts of Europe, and a BRICS bloc, China, Russia, India, Global South, each with its own currency reserves, payment systems, and trade rules. If you are finding value in this analysis and want to stay updated on these critical economic shifts, please hit the like button and subscribe to the channel. Your support helps us bring this information to more people who need to hear it. So how do we move forward and navigate this new reality? Friends, I tell you this not to frighten you, but to prepare you. The fear many feel today comes from uncertainty, from the sense that the ground is moving beneath our feet. And it is. The era of total US dominance, the era where the American dollar was as good as gold, is over. The check that the world signed for America 50 years ago has finally bounced. But this is not necessarily the end of the world. A multipolar world, where power is balanced between several great nations rather than held by one, could eventually be a more stable and just world. It prevents any single nation from acting with impunity. However, the transition, the period we are living in right now, is volatile. It is messy. It is dangerous. My advice to you is this: do not let yourself be distracted by the noise. The politicians will scream about scandals, tweets, and culture wars. The news will try to scare you with the latest crisis of the week. But the real story is in the silent moves. Watch the gold. Watch the central banks. Watch who is trading with whom and in what currency. The earthquake has already happened. The tectonic plates have shifted. The landscape of the 21st century has changed. Our job now is not to deny it, but to understand it, so that we can navigate this new world with wisdom and security. Thank you.